Hello guys, welcome to i-tutor Academy. In today's session, we will start with Unit 1, Subsection 7, Accounting Framework, MMBC 004. The rules and convention of accounting are commonly referred to as the conceptual framework of accounting. As with any discipline or body of knowledge, some underlying theoretical structure is required if a logical and useful set of practices and procedures are to be developed for reaching the goals of the profession and for expanding knowledge in that field. Such a body of principle is needed to help answer new questions that arise. No profession can thrive in the absence of a theoretical framework. According to Henriksen, accounting theory may be defined as logical reasoning in the form of a set of broad principles that provide a general frame of reference by which accounting practice can be evaluated and guide the development of new practice and procedures. Accounting theory may also be used to explain existing practices to obtain a better understanding of them. But the most important goal of accounting theory should be to provide a coherent set of logical principles that form the general frame of reference for the evaluation and development of sound accounting practices. The American Institute of Certified Public Accountant AICPA discusses financial accounting theory and generally accepted accounting principle as follows. Financial statements are the product of process in which a large volume of data about aspect of the economic activities of an enterprise are accumulated, analyzed and reported. This process should be carried out in accordance with generally accepted accounting principles. Generally accepted accounting principle incorporate the concerns at a particular time as to which economic resources and obligations should be recorded as assets and liability by financial accounting. Which changes in asset and liability should be recorded. When these changes should be recorded, how the asset and liability and changes in them should be measured, what information should be disclosed and how it should be disclosed, and which financial statement should be prepared. Generally accepted accounting principles encompass the conventions, rules, and procedures necessary to define accepted accounting practices at a particular time. Generally accepted accounting principles include not only a broad guideline of general application but also detailed practice and procedures. The word principle is used to mean a general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. You will note that this definition describes principle as a general law or rule that is to be used as a guide to action. This implies that accounting principles do not prescribe exactly how each detailed event occurring in business should be recorded. Consequently, there are several matters in accounting practice that may differ from one company to another. Accounting principles are man-made. They are accepted because they are believed to be useful. The general acceptance of an accounting principle that is usually depends on how well it means the three criteria of relevance, objectivity, and feasibility. A principle is relevant to the extent that it results in meaningful or useful information to those who need to know about a certain business. A principle is objective to the extent that the information is not influenced by the person, bias, or judgment of those who furnished it. Objectivity cannot reliability or trustworthiness, which also means that the correctness of the information reported can be verified. And accounting concept, earlier we had described accounting as the language of business. As with language, accounting has many dialects. There are differences in terminology. In dealing with the framework of accounting theory, one is confronted with a serious problem arising from differences in terminology. A number of words and terms have been used by different writers to express and explain the same idea or notion. Without falling into the trap of this terminological maze, we are explaining below some widely recognized ideas and we call all of these concepts. We do feel, however, that some of these ideas have a better claim to be called concepts, while the rest should be called conventions. And business entity concept. In accounting, we make a distinction between business and the owner. All the records are kept from the viewpoint of the business rather than from that of the owner. An enterprise is an economic unit separate and apart from the owner or owners. And this distinction can be easily maintained in the case of a limited company because a company has a legal entity of its own. And like a natural person, it can engage itself in economic activities of producing, owning, managing, storing, transferring, lending, borrowing, and consuming commodities and services. And next one is money measurement concept. In accounting, only those facts which can be expressed in terms of money are recorded, as money is accepted not only as a medium of exchange but also as store of value. It has a very important advantage since a number of widely different assets and equities can be expressed in terms of a common denominator. Without these adding heterogeneous factors like 5 buildings, 10 machines, 6 trucks will have much meaning. And while money is probably the only practice common denominator and the yardstick, we must realize that this concept imposes two severe limitations in the first place. And there are several facts which, though vital to the business, cannot be recorded in the books of account because they cannot be expressed in money terms. And examples also right there. You just once go through your material also for more explanation and examples. And secondly, use of money implies that a rupee today is equal value to rupee 10 years back or 10 years later. In other words, we assume stable or constant value of rupees. In the accounts, money is expressed in terms of its value at the time an event is recorded. Subsequent changes in the purchasing power of money do not affect this amount. You are perhaps aware that most economies today are the inflationary conditions with the rising prices. The value of a rupee of 1980s has depreciated to an unbelievably low level of the 90s. And next one is a continuity concept. Accounting assumes that the business, that is accounting entity, will continue operate for a long time in future unless there is good evidence to the contrary. The enterprises is viewed as a going concern, that is as continuing in operation at least in the foreseeable future. The owners have no intention nor have they the necessity to wind up or liquidate its operations. This assumption is of considerable importance, for it means that the business is viewed as a mechanism for adding value to resources it uses. And the assumption that the business is not expected to be liquidated in the foreseeable future, in fact, establishes the basis for many of the valuation and allocation in accounting. And next one is cost concept. The resources, that is resources are land, building, machinery, property rights, etc. are the resources that a business owns are called assets. The money value that are assigned to asset are derived from the cost concept. This concept states that an asset is worth the price paid for or cost incurred to acquire it. These assets are recorded at their original purchase price, and this cost is the basis for all subsequent accounting for the asset. In case of certain asset, the accounting value and market value may be similar. Cash is an obvious example. In general, the longer an asset has been owned by the company, the lesser are the chances that the accounting value will correspond to the market value. The cost concept does not mean that all assets remain on the accounting records at their original cost for all time to come. And you must be wondering as to why assets are shown at a cost even when there are wide difference between their cost and market values. The main argument is that the cost concept meets all the three basic criteria of relevance, objectivity, and feasibility. And accrual concept, the accrual concept make a distinction between the receipt of cash and the right to receive it, and the payment of cash and the legal obligation to pay it. In actual business operations, the obligations to pay and the actual movement of cash may not coincide. The accrual concept recognizes this distinction in connection with the sale of goods. Revenue may be received before the right to receive arises or after the right to receive has been created. The accrual concept provides a guideline to the account as to how he should treat the cash receipt and the right related thereto. In the former case, the receipt will not be recognized as the revenue of the period for the reason that the right to receive the same has not yet arisen. In the latter case, the revenue will be recognized even though the amount is received in the subsequent period. And next one is concept of conservatism. The concept of conservatism, also known as the concept of prudence, is often stated as anticipate no profit provide for all possible losses. This means an accountant should follow a cautious approach. He should record lowest possible value for asset and revenues and the highest possible value for liabilities and expenses. According to this concept, revenue or gains should be recognized only when they are realized in the form of cash or asset and usually legally enforceable debts, the ultimate cash realization of which can be assessed with reasonable certainty. Further provision must be made for all known liabilities, expenses, and losses, whether the amount of these is known with certainty or is at best an estimate in the light of the information available. Next is materiality concept. There are many events in business which are trivial or significant in nature. The most of recording and reporting such a event will not be justified by the usefulness of the information derived. Materiality concept holds that item of small significance need not be given strict theoretically correct treatment. For example, a paper stapler costing Rs 30 may last for 3 years. Okay, so there is examples are quoted one by one. Where to draw the line between material and immaterial events is a matter of judgment and common sense. There are no hard and fast rules in this respect. Whether a particular item or occurrence is material or not should be determined by considering its relationship to other items and the surrounding circumstances. It is desirable to establish and follow uniform policies governing such matter. Next is consistency concept. In practice, there are several ways to record an event or a transaction in the books of account. For example, the trade discount on raw material purchased may be deducted from the cost of goods and net amount entered in the books. Or alternatively, trade discount may be shown as the income with the full cost of raw material purchased entered in the books. And similarly, there are several methods to change depreciation on an asset or of valuating inventory. The consistency concept requires that once a company has decided on one method and has used it for some time, it should continue to follow the same method or procedure for all subsequent events or the same character unless it has a sound reason to do otherwise. And you will appreciate that much of the utility of accounting information lies in the fact that one could draw valid conclusion from the comparison of data drawn. And next one is periodicity concept. Although the results of operation of a specific enterprise can be known precisely only after the business has ceased to operate, its assets have been sold off and liabilities paid off, the knowledge of the result periodically is also necessary. And the allocation of long-term cost and the difficulties associated with this process directly stem from this concept. While matching the earning and the cost of those earning for any accounting period, all the revenues and all the costs relating to the year in question have to be taken into account irrespective of whether or not they have been received in cash or paid cash. While going through all these concepts, probably you have developed a feeling that they come in conflict with each other. And there is examples also. In the first place, the stability of purchasing power of money implied in the money measurement concept prevent us from recognized accretion in values as are a result of changing price levels. Then the realization concept will not all not allow unrealized profit to be included as long as land is held by the company and not sold away. Okay, and next is accounting standards. The basic concepts discussed in the foregoing paragraph are the core element in the theory of accounting. These concepts, that is postulated or convention, however, permits a variety of alternative practice to coexist. And the need for standards. The information contained in published financial statement is of particular importance to external users such as shareholders and investors. Without such information, they would not be able to take a right decision about their investment. And next one is in changing nature of generally accepted accounting principle, that is GAAP. Generally accepted accounting principle are usually developed by professional accounting bodies like American Institute of Certified Public Accounts and Institute of Chartered Account of India. In developing such a principle, however, the accounting profession has to reflect the realities of social, economic, legal, and political environment in which it operates. Besides academic research, regulatory, and tax law of the government, example Companies Act 1956, Income Tax Act 1961, etc., in a large measure influence the formation of acceptable accounting principles. Stock exchange and other regulatory agencies like Securities and Exchange Board of India have laid down rules for disclosure and extent of accounting information. And a summary of this chapter is here. Accounting can be defined as process of reporting, recording, interpreting, and summarizing economic data. You just by heart one definition of accounting, it will help you for your final exam answers. Okay, and assets are those resources owned by organization which helps the company to profit. All these things we characteristics of accounting already we covered, objectives of accounting, right? All things we already covered in this chapter. You just go through the summary one by one. And self assessment questions also there. There is around 9 questions, right? Yeah, yes, around 9 questions are there, and subsections also there. You just try to answer these questions and based on this chapter only. If you have any doubt, you can contact our contact number. Also, you can comment it on our comment box. Okay, so first question is confidence and trust that reported information is a reasonable representation of actual items and events that have occurred indicate which qualitative characteristics of accounting information. Second is state whether a large order of supply of goods received by the firm be recorded in books. Okay, and appointment of a new managing director is not recorded in the book of account. Why? Okay, all these things we already discussed. You just go through our previous videos, then you can answer these questions also. What is a person to whom money is owned by fame called? And Mr. Raja, an electronic goods dealer, gifted a microwave of value R30,000 to his friend Rohan and recorded it in book as drawing. Is he correct? Distinguish between financial accounting, cost accounting, and management accounting. It's a direct question. And distinguish between bookkeeping, accounting, and accountancy. We already discussed. Also a direct question. And basic objective of accounting is to provide useful information to various users. Besides these, there are many other objectives of accounting. Explain any four of them. And select an appropriate options. Okay, option based questions also there. You just go through it and try to answer all these questions. It will help you for your term and examination. Okay, and for more videos, this is about unit 1 of MMBC 004, and next videos we will cover on upcoming videos. And for more videos, you just do like, share, and subscribe our channel. Thank you.
i-tutor ES presents IGNOU MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.